you check your retirement account balance again. Same number as this morning. You check it anyway. Somewhere along the way, saving for retirement stopped feeling like a plan and started feeling like a habit you can't put down. But the real answer to when you can stop is far stranger than save more. It has a number, it has a date. And for most people, that date arrives years before they think it does. Here is the question nobody asks you. Not your bank, not your employer, not even most financial advisors. The question is not how much can you save? The question is how much do you actually need? Those are two completely different problems, and confusing them is the single most expensive mistake in personal finance. Think about what a retirement account is actually for. It is not a trophy. It is not a scoreboard you compare with coworkers at lunch. It is a machine built to convert your working years into future spending. Once that machine can produce enough spending to cover your life, every additional dollar you feed it stops improving your retirement. It only inflates the size of the estate you leave behind. Is that really the goal? For most of financial history, nobody had a reliable way to answer this. Retirement planning was guesswork dressed up as certainty. Then, in 1994, a financial planner named William Bengen sat down with decades of stock and bond market data and asked a simple, almost embarrassingly obvious question. If a retiree withdrew a fixed percentage of their portfolio every year, adjusted for inflation, what withdrawal rate would have survived every terrible market in American history? Not the average market, the worst one. Bengen tested rate after rate against the worst starting points in modern history, including retirees who began withdrawing right before the Great Depression and right before the stagflation of the 1970s. He found that a withdrawal rate of around 4% of the original portfolio, adjusted upward each year for inflation, survived every single one of those brutal 30-year stretches. That number became famous. It became a rule of thumb repeated so often that people forgot it was ever a discovery. But here's what almost nobody remembers about it. Bengen's rule was never a rule about saving. It was a rule about spending. A few years later, 3 finance professors at Trinity University ran a similar test, using a wider range of asset mixes and withdrawal rates. Their paper became known simply as the Trinity Study, and it confirmed the same uncomfortable truth Bengen had already found. Once your portfolio reaches roughly 25 times your annual spending need, history says you are very likely funded for a 30-year retirement. 25 times your spending, not 25 times your income. Not some vague multiple of your salary. 25 times what you actually spend to live the life you want. Sit with that distinction for a moment. 2 people earning the exact same salary can have wildly different retirement numbers because their spending is different. The person who saves aggressively and lives modestly may need far less than the person who earns the same amount but spends nearly all of it. Your number is personal. It is built from your actual life, not from a chart in a magazine. So why does almost nobody stop saving when they hit their number? Because retirement planning culture never taught people to look for a finish line. It taught them to keep running. Financial media rewards fear. Fear keeps people clicking, keeps people buying products, keeps people saving past the point where saving helps them. Nobody sells a headline that says, "You already have enough." That headline doesn't generate advertising revenue. "You might run out of money" does. Let's build the real number using a household most people would recognize. Call them the Halversons. Husband and wife, both 52 years old. Combined income of $160,000 a year. They have been diligent savers for 2 decades, and their retirement accounts, added together, sit at just under $1.4 million. They plan to retire at 62, 10 years from now, and they expect to live comfortably into their 90s, so they are planning for a 33-year retirement horizon. The first step is not looking at their savings balance. The first step is figuring out what their life actually costs, not their income, their spending. After digging through a year of bank statements, the Halversons find they spend about $88,000 a year to live the life they want, including travel, a paid-off mortgage, healthcare premiums, and a reasonable cushion for the unexpected. That number, not their salary, is the real target of the entire exercise. Next comes Social Security, and this is where most retirement calculators quietly mislead people. 2 working spouses do not just get one Social Security check. They often get two, and depending on the age each spouse claims, those benefits can meaningfully shrink the amount their portfolio needs to cover. Based on their earnings history, the Halversons are projected to receive a combined $62,000 a year in Social Security if they claim at their full retirement age of 67. That is not a footnote. That is more than two-thirds of their annual spending covered by a source that has nothing to do with their portfolio. Here is where the strange part of retirement math shows up. The years between when you stop working and when Social Security begins are dollar for dollar, the most expensive years of retirement. During that gap, your portfolio has to cover 100% of your spending alone because the government check has not started yet. For the Halversons, retiring at 62 means 5 years, from 62 to 67, where their portfolio alone must produce the full $88,000 they spend every year. Only after age 67 does Social Security step in and shoulder most of the load. This changes the entire shape of the retirement number. It is not one flat target. It is closer to a decreasing staircase. The portfolio needs to be largest in the early bridge years and can gradually shrink in its responsibility as guaranteed income takes over. A retirement calculator that just multiplies your spending by 25 without separating the bridge years from the Social Security years will almost always overstate what you truly need, sometimes by a wide margin. Now add taxes, because pre-tax retirement accounts are never fully your money. A dollar sitting in a traditional 401k is a dollar you share with the government, and the size of that share depends on how much you withdraw and when. The Halversons keep a blended estimate of about 15% for federal and state taxes on their withdrawals, which is conservative but realistic given today's brackets. That means every dollar of spending they need actually requires a little more than a dollar of withdrawals to cover the tax bill that comes with it. Now for the number that actually matters, the return assumption. This is where overly optimistic retirement math quietly wrecks people's plans. Long-run stock market averages sound wonderful in a spreadsheet, but nobody retires into an average. They retire into a specific decade, with specific market conditions, and sequence of returns risk means that a bad string of early losses can permanently damage a portfolio even if the long-term average eventually looks fine. A conservative real return assumption, meaning growth above inflation of around 3.5% a year, is a reasonable planning baseline for a balanced portfolio during retirement. It is not the exciting number you see in bull market headlines. It is the number that survives bad decades, not just good ones. Put all of these pieces together: the $88,000 spending target, the 5-year Social Security bridge, the 15% tax drag, and the 3.5% conservative real return. And something remarkable happens. The Halversons do not need 25 times $88,000, which would suggest a portfolio north of $2 million, because Social Security replaces such a large share of their spending after age 67 and because the bridge years are a defined shrinking obligation rather than a permanent one. Their actual funding target lands closer to $1.3 million once a reasonable safety margin is added. That safety margin matters more than people think. Financial researchers, including planning expert Michael Kitces, have written extensively about the fact that most retirees following the 4% rule do not spend down to zero. They end up with more money than they started with because the rule is calibrated to survive the worst historical outcomes, not the average one. Even so, adding a margin of about 30% above your bare minimum number is a smart hedge against the specific bad luck of retiring right before a market downturn. For the Halversons, that pushes their real target from $1.3 million to somewhere close to $1.7 million. Here's the twist. Remember, the Halversons already have $1.4 million saved. At age 52, with 10 years left until their planned retirement date, if they keep contributing at their current pace and their portfolio grows even modestly, they will not just reach $1.7 million by 62. Running the math forward, they are on pace to cross that threshold years earlier than they expected. Somewhere around age 57, according to their own trajectory, their portfolio is projected to already be fully funded for the retirement lifestyle they actually want. That single sentence should stop you in your tracks. Fully funded at 57. Not 62, not 65, 57. Every dollar the Halversons contribute after that point is not buying them a better retirement. Their retirement was already bought. Every additional dollar is simply buying a larger number on a statement. or a larger inheritance for whoever comes after them. This is the moment almost nobody plans for because almost nobody is taught to look for it. Once you are fully funded, you face a real decision, and it is not the decision the financial industry usually presents to you. It is not, should you retire immediately? It is, what should your next dollar buy? Continuing to work does not have to mean continuing to save at full speed. There is a middle path most people never consider. Once a plan is fully funded, contributing beyond your employer's matching contribution has a strange kind of negative value. If your employer matches, say, 4% of your salary, that match is close to free money, and it is worth capturing regardless of how funded you already are. But contributing beyond that match, once your number is already met, is not making your future self richer in any way that improves your life. It is simply deferring spending you have already earned the right to do. This is where the Halverson story becomes a decision rather than a calculation. At 57, they have three real paths in front of them. Path 1. Retire now, 5 years earlier than planned, and rely on their already fully funded portfolio, plus their future Social Security benefit. Path 2. Keep working the same jobs, but redirect the money they were saving beyond the employer match into something else entirely, whether that is more travel now, helping their kids, or simply working fewer hours. Path 3. Keep saving at full speed exactly as before, and accept that the extra money is not funding a better retirement, only a larger one. None of these paths is wrong, but only one of them is informed. Most people never run this math, so most people default to path 3 without ever realizing they had two better options sitting in front of them the entire time. Why does this happen so rarely? Because the entire retirement industry is built around a single, simple, repeatable message. Save more. It is not a conspiracy. It is an incentive structure. Financial firms earn fees on assets under management, which means every dollar you keep contributing, even past the point of usefulness, is a dollar that benefits the institution holding your account. Nobody at your brokerage is going to call you and say, "Congratulations, you can stop now." That call has to come from your own math, because it will never come from the industry that profits from you not doing it. There is a psychological trap hiding underneath all of this, and it deserves its own name. Call it the treadmill effect. When you spend 2 or 3 decades in accumulation mode, saving becomes an identity rather than a strategy. People who are excellent savers often struggle the most with recognizing when to stop, because the habit that built their wealth becomes indistinguishable from who they think they are. Letting go of that habit, even after the math says it is safe, can feel less like a financial decision and more like losing a part of yourself. But look again at what the number is actually telling you. It is not telling you to stop being disciplined. It is telling you that your discipline already worked. The entire point of 2 decades of saving was to eventually reach a place where the next dollar of your life could go toward living instead of toward more saving. Missing that moment and continuing to grind past it out of habit or fear is its own kind of loss. It is a loss of time you cannot get back, spent accumulating money you will likely never spend. This is also why your retirement number is not fixed. It moves as you age and almost always in your favor. Every year that passes is one fewer year. Your portfolio needs to cover 1 year closer to Social Security, 1 year of market growth compounding on what you already saved. This is why the same household that needed $1.7 million at 52 might genuinely need less by 57, even before accounting for the market gains along the way. Your number is not a wall you slam into. It is a target that keeps drifting closer to you as time passes, as long as your spending stays roughly stable. There is another layer to the Halverson story worth pulling apart, and it involves the order in which they draw down their accounts once retirement actually begins. Not all dollars are taxed the same way, and the sequence in which you spend from a traditional 401k, a Roth account, and an ordinary taxable brokerage account can meaningfully change how long your money lasts. Withdrawal sequencing research, including work published by economist Wade Pfau, has shown that retirees who draw from taxable accounts first let tax-deferred accounts continue growing and save Roth withdrawals for later years or emergencies, often stretch their portfolios further than retirees who withdraw proportionally from everything at once. For the Halversons, roughly 70% of their $1.4 million sits in traditional retirement accounts, 20% in a Roth, and the remainder in a taxable brokerage account built from a decade of extra saving beyond their 401k limits. spending down that taxable account first during the bridge years before Social Security begins reduces their taxable income in those early years and can even open the door to strategically converting a portion of their traditional balance into Roth dollars while their tax bracket is temporarily lower than it will be later. This is not just an academic exercise. It changes real numbers. A retiree who ignores account sequencing and simply withdraws everything proportionally can end up paying meaningfully more in lifetime taxes than one who plans the order deliberately, even when the two households start with the identical portfolio balance. The Halversons' $1.7 million target already assumes a fairly blended conservative tax rate, but a smarter sequencing strategy could stretch that same portfolio even further. Or let them retire with an even larger safety margin than the math alone suggests. Why does nobody mention this? Because sequencing strategy does not sell a product. It is simply a matter of ordering decisions correctly. And ordering decisions correctly is not something the financial industry has ever found a way to charge much for. There is also the matter of healthcare, which quietly terrifies almost every retiree who considers leaving work before Medicare eligibility at 65. The Halversons, retiring in this hypothetical scenario at 57, would face roughly 8 years without employer-sponsored insurance and without Medicare. Health insurance purchased on the open marketplace, especially for a household with a fairly high income relative to subsidy thresholds, can easily run $15,000 to $25,000 a year for a couple in their late 50s. That cost is not a footnote to be weighed the way. It has to be built directly into the $88,000 spending figure used throughout this entire calculation, and for many households, healthcare alone is the single largest bridge year expense, larger even than housing or travel. Ignoring it is exactly how an otherwise careful retirement plan quietly fails in year 3. Consider what this means beyond the Halversons' specific numbers. This is not really a story about one household with $1.4 million. It is a story about the gap between what people believe about their finances and what their finances actually say when someone finally does the math honestly. Most people have never calculated their real number. They have a vague sense that more is better, and a vague fear that they might run out, and they let those two vague feelings dictate an extra 5, 7, sometimes 10 years of unnecessary saving and working. Compare that to how companies think about capital. A well-run business does not keep raising money indefinitely just because raising money feels safe. It raises exactly what it needs to fund its plan, and it deploys the rest toward growth, toward paying people, toward returning value to shareholders. Amazon spent years reinvesting nearly every dollar of profit back into the business, not because more cash sitting idle was valuable, but because every dollar had a specific job to do. Vanguard, the investment firm built by John Bogle, was founded on almost the opposite premise from most of Wall Street, structured so that its owners are its own fund investors, which is part of why low-cost index investing became the default engine so many retirement plans, including the Halversons, quietly rely on today. In both cases, the lesson is the same. Capital without a purpose is not virtue. It is waste sitting in disguise. Your retirement account deserves the same discipline. Not the discipline of blindly maximizing the balance, the discipline of funding a specific, calculated outcome, and then redirecting your effort once that outcome is secured. Anything else is not prudence. It is autopilot. So how do you find your own version of the Halversons age 57? Start with your actual spending, not your income, tracked honestly over at least 6 months. Add your expected Social Security benefit at a couple of different claiming ages, since that single choice can shift your number by hundreds of thousands of dollars. Separate your bridge years, the years before guaranteed income begins, from the years after, because they require completely different levels of portfolio support. Apply a conservative real return, not a hopeful one, and then add a safety margin on top, because a plan that only survives the average outcome is not a plan built for real life, where averages are rare and bad decades happen to real people at random points in time. Once you have that number, check it against what you already have, and check it again every year, because it moves. The year you find your portfolio has crossed that number is not the year you necessarily quit your job. It is the year you finally get to choose, with real information instead of vague anxiety, what your next dollar is actually for. Maybe your next dollar buys freedom, in the form of retiring early, like the Halversons could. Maybe it buys flexibility in the form of working fewer hours at the same job, once you're only contributing enough to capture your employer's match. Maybe it buys presence, the ability to take the trip, help the family member, or simply stop treating every unnecessary hour of overtime as sacred. The specific choice is yours. What is not yours to skip is doing the math that reveals you have a choice at all. You check your retirement account balance one more time. Same number as this morning, technically, but you see it completely differently now. It was never really about the number climbing higher forever. It was about the number reaching a specific point, quietly. One ordinary year, after which every dollar past it was never really about your retirement at all. It was about what you decide to do with a life that, it turns out, was already paid for.